Let's jump right into the core of how markets actually price assets. Today's explainer is all about the duality of risk, specifically the profound difference between diversifiable and market risk. If you really want to understand portfolio construction and asset pricing, well, this is the master key. It's going to totally change how you look at your investments. Here is our roadmap for this explainer. We're going to redefine financial risk, look at the two distinct types of risk, dive into the magic of diversification, unpack exactly why market risk matters, and finally, look at how we measure it.
Section 1. Redefining financial risk.
So, before we can even measure risk, we have to tackle the emotional baggage attached to the word. Usually we think of risk purely as a hazard, right? Like getting a speeding ticket or getting into a fender bender. Pure danger. But take a look at the Chinese symbols for risk. It's absolutely fascinating. The first character means danger, sure, but the second one, that stands for opportunity. And that right there beautifully captures the fundamental trade-off every single investor makes. There is literally no upside opportunity without bearing the downside danger. It's a duality.
And that duality leads us directly to our formal definition. In the finance world, risk isn't just about losing your shirt. Risk is simply the likelihood that your actual returns will differ from your expected returns. So yes, that includes downside losses, but it also encompasses upside gains. We're shifting our mindset here from a vague feeling of danger to a hard statistical reality. The greater the variance around that expected return, the riskier the investment. Simple as that.
Section 2. The two types of risk.
Okay, so we know risk is actual returns straying from expectations. But why do they stray? Well, we can actually sort the reasons into two totally different buckets. On one side, we've got firm-specific risk. This is stuff that impacts just one or maybe a handful of investments. Think about Boeing misjudging demand for a massive new jet, or Disney launching a teen magazine that completely flops. If those projects tank, Boeing and Disney take a hit, but the broader stock market, it barely notices. But then on the other side, we have market risk. This is the macro stuff that hits many or even all investments. A global interest rate hike, a recession. Those macro events send ripples through basically everything. Let's actually look at how this builds across the spectrum. At the micro level, you have project risk, like a single product launch failing. Zoom out a bit and you hit competitive risk, say Airbus steals a major contract from Boeing. Zoom out a little further to sector risk. Maybe defense budgets get slashed, hitting all defense contractors. And finally, you reach the absolute macro level, market risk, massive forces like inflation that drag on the entire economy.
When you look at it mapped out on this spectrum, you'll notice a gray area right in the middle. Things like shifting exchange rates or political instability sit right in that transitional zone. Why? Because it really depends on a firm's global footprint. A super strong US dollar might just be a firm-specific risk if only a couple of companies operate overseas. But if nearly every firm in the index is globally integrated, well, suddenly that exchange rate acts a whole lot more like a market-wide risk.
Section 3. The magic of diversification.
Now, I want you to think about this question. Why exactly does diversification eliminate firm-specific risk? We hear the rule, diversify your portfolio all the time, right? But mechanically, what is actually happening? How does just buying more assets magically make risk disappear? It essentially comes down to two really intuitive reasons. First off, as you add more assets, each individual investment becomes a much smaller piece of your total pie. If one single company has a disastrous quarter, it's just a tiny drop in your overall bucket. But second, and this is absolutely crucial, the effects of these firm-specific events are basically random. In any given month, some companies are going to have amazing, unexpected wins, and others are going to have terrible, unexpected losses. In a large enough portfolio, those positive and negative surprises literally just average out to zero. It's like flipping a coin 1,000 times. The end result is incredibly predictable. You've essentially erased that firm-specific danger using pure math.
Section 4. Why market risk matters.
So here's the absolute game changer. We have to look at risk through the eyes of the marginal investor. That's the person or the massive institution who's actually out there trading at the margin and setting asset prices. Now, the standard assumption in finance is that this marginal investor is incredibly well diversified, they're holding huge index funds and massive broad portfolios. That means they have already completely eliminated firm-specific risk from their portfolio, and they did it for virtually zero cost. And that leads us to this massive aha moment.
Only market risk will be rewarded and priced. Seriously, think about it. If the giant institutional investor setting the price of a stock has already diversified away all the firm's specific risk, why on earth would they demand a premium for it? They absolutely wouldn't. The market is not going to pay you extra returns for taking on the specific risk of one single company simply because you could have eliminated that risk for free. The only risk the market compensates you for is the risk you can't run away from, the market risk.
Section 5. Measuring your market risk. So how do we actually put a number on this? Well, there are 4 main valuation models out there, and while they all totally agree that only market risk gets rewarded, they completely disagree on how to actually measure it. First up is the CAPM, or Capital Asset Pricing Model. This is the industry standard. It assumes there's one giant market portfolio, and it measures risk using a single beta, which basically just tracks how much a specific asset swings compared to the broader market. Then you've got the arbitrage pricing model, which argues, hey, there are actually multiple unspecified factors driving this risk. Taking that a step further, the multi-factor model actually names those macroeconomic factors, stuff like inflation or interest rates, and tracks betas against them specifically. And finally, proxy models. These look at historical data and say, look, over long stretches of time, things like a company's market cap or price-to-book ratio correlate with higher returns, so those characteristics must just be proxies for market risk.
Which brings us to one final, really provocative thought to leave you with. If the market purely rewards market risk and actively ignores firm-specific risk when it's setting prices, is your portfolio truly diversified? Or are you out there holding onto concentrated, unrewarded danger that the market is never ever going to pay you for? It's a pretty heavy question to ask yourself the next time you look at your assets. Thanks so much for hanging out with me for this explainer. I'll catch you in the next one.